Okay, so very good morning. Welcome to the briefing for Tuesday, the 9th of August. Just taking a quick look then at yesterday. What I'm sharing with you, the bottom left-hand chart here, is the S&P. Looking at the kind of range that we had from 73 up to 83 yesterday. Again, yesterday was very quiet, and I would be expecting that to be quite a prevalent theme this week. We've kind of had the major central bank decisions from the ECB, the Bank of England last week, the BOJ. They all don't really meet again until September. And then ECB speakers, their schedule is empty over August as they take a holiday. And economic data this week is also quiet. So that in combination with the Olympics ongoing, I'm going to be expecting a similar kind of price action throughout this week as what we saw yesterday. So you're going to have to get used to that. The main thing I think in these conditions is remaining disciplined, because quite often just out of sheer boredom you can get drawn into moves that otherwise you probably wouldn't have taken. But certainly there was a decent move in oil yesterday. So have a quick look at that. And we've been seeing since really payrolls a bit of a bounce off this fairly aggressive trend lower that we saw kind of from July into August, where we fell from 50. We kind of gravitated for a week or so around 45 before then breaking $40 briefly for around a day and a half or so, and this latest bounce. Now, the bounce has been on a couple of things. I think it started when you had a bit of an about change in US output, which fell last week after 3 consecutive weeks of increasing. That was from the weekly DOEs we had last Wednesday. You then also had the non-farm payrolls report coming out of the US, which was extremely strong and kind of flew in the face against the weak GDP Q2 number that we had the week prior from the US. So at that point, that was when oil was around its lows, when there was concerns that US growth was much weaker than anticipated. It was less than half the consensus estimate when that came in at 1.2%. But since then, payrolls has been strong. You're in this termed Goldilocks scenario, which is why equities have generally remained up at these elevated all-time high levels. That combination then that rates aren't going up anytime soon, so continued accommodative policy with underlying strength in the jobs situation in the US, fueling that. And that's also helped on the demand side dynamic for crude oil as well, pulling it back above 40. And then yesterday, a decent 2.5-3% gain in oil came after the Venezuelan oil minister said that a meeting between OPEC and non-OPEC countries may take place in the coming weeks as the crisis-stricken South American nations sought to prop up weak oil markets. Some OPEC officials have said a global oil output freeze could be discussed at an already scheduled September meeting of the organization, but non-OPEC Russia, which, don't forget, is the world's largest oil producer, said it does not see any grounds for holding production at current levels. So, if you remember where we were trading, and let me just make this chart a bit longer dated, to where we were back in January and February. This is kind of when the fallout, China concerns were at their most ferocious when we first came into our trading desk at the beginning of Jan. And those concerns about hard landing, that demand out of one of the largest consuming energy nations on the planet, certainly saw oil come under pressure. And at that time, any of you who were trading crude oil will remember there was a lot of danger with kind of headline-driven moves that were coming out. There was rumors about Russia talking to various countries, about emergency meetings, and so on and so forth. It's very interesting then to see at this point that you've almost started to see a bit of this verbal intervention now happening in crude oil, but around the $40 handle. It seems that when we breach 40, and over the weekend, that's when you've had a lot of these noises start to re-emerge, when really it was when we broke 30 when they started to get more aggressive on the kind of communication side, that threatening about this word of freezing production started to come around. So it seems to be the fact that these OPEC names particularly the likes of Nigeria, Venezuela, the ones that are feeling the most fiscal pressure on these low oil prices. Not surprising to hear them commenting again. Again, it's going to be the likes of what Russia really says and what Saudi says. It's going to be of critical importance. So if you hear of any of those names speaking on the squawk, you need to be paying attention at all times. But it seems as though 40 is the new line in the sand for them for the moment. And with that being said, I do foresee that kind of 40 to 45 type area being the new norm for potentially this week, given the light calendar and events. One thing though is, as I say, I see 45 as a kind of near-term top. We're around $2.50 from that at the moment. Now, the reasons why I see that is that you did have the Baker Hughes rig count last Friday. Kind of went a bit unnoticed, but US rig counts have gone up 9 of the last 10 weeks. So certainly, although US output fell for the first time in 4 weeks last week, the rig count number is continuing to move higher. That in combination, I feel, with the Cushing number we had from Genscape, don't forget, yesterday, that was our first insight in toward what the API and DOEs could hold in terms of builds and draws, and that Genscape number was a build of more than 300,000 barrels at Cushing, Oklahoma. Now, although the market rallied yesterday, infantry builds and increasing US oil rig counts, I feel, will provide a bit of a near-term top to these oil prices once we get in toward that $45 handle. Again, headline risk, just be aware of that. Anything out of Russia certainly will be important for that market. A quick look elsewhere. The pound this morning, looking at that top left chart. Some quite interesting moves that we've had here. Obviously, we had the big flush lower when the Bank of England last week delivered their three-way package, that kind of cut in rates, the 60 billion QE, the corporate buying of 10 billion, and that new lending facility to facilitate liquidity for some of the banks. That was when we made that push lower. We broke that kind of support level that was holding through much of mid to late July. And then non-farm payrolls, seeing the dollar strengthen aggressively on the back of that, has helped us breach that level. And this morning, we have traded a sub 130 handle, sitting pretty much on that at the moment. Now, why the renewed pressure that we've seen overnight? Because looking at this is now a 15-minute chart. You can see here we've had a pretty big sell-off in overnight trade. Actually, since Europe has come in, if anything, we've moved higher. But we declined from roughly 130.50 to sub 130 overnight. So why was that? Well, there was an article, an open editorial piece out of one of the main Bank of England MPC members. That's Ian McCafferty. Now, don't forget, you need to put this in context. McCafferty formerly was one of the most hawkish members on the MPC. Now, although we know that the MPC voted 9-0 to cut, so he would have advocated the cut in rates, he has said overnight in the Times that more quantitative easing was likely to be required if the UK's economic decline worsens. Most importantly, that comment, to put it in a bit of context, McCafferty was one of the 4 external members of the 9-person MPC that had opposed raising the target for QE. So last week, when QE got raised from 375 to 435 billion, McCafferty was one of those who argued and voted against that happening. But overnight, he said that more QE was likely to be required. So quite a big dovish statement there, coming out of formerly one of the most hawkish members of the Monetary Policy Committee of the Bank of England. As such, that's why you got that big push lower. And in terms of the way that these news stories get released, generally speaking, obviously the news, as you know now, is 24 hours, but the front page of the business section of the printed Times normally gets released electronically around midnight on the Times website. And if you look at this sell-off, we were literally going sideways for most of the US session, and then when that article came out just after midnight, that's when the selling took place. That kind of midnight to 145, a decent drop of over 50 pips, eventually going through that handle. So that kind of hopefully explains some of that movement in the pound. Elsewhere, the DAX looking slightly longer dated. Again, we kind of gapped up to recommence trade yesterday. We tested that briefly in the morning before then bouncing back up, and we remain kind of defined by that range for the time being. That's kind of the upside level to be aware of, that 10,472, which was the August 1st high. Anything above there, then looking at R2 and then the 10,500 level, should we move higher at any point today. Finally, in terms of what has other things that have come out from overnight, we did have Chinese inflation data. Not really too much of a focus for the market at this point in time, but consumer prices in China rose 1.8% July of 2016. That was in line with market consensus. It was, though, the lowest rate since January, as the political sensitive food price increased by 3.3%, while non-food cost prices rose by 1.4%. So looking at that, that's around a 6-month matching the Jan low, let's say, for the reading inflation from CPI overnight in China. Quick look ahead then in terms of the calendar for today. As I said, things are likely to be pretty quiet. A lot of the major announcements to come out of the market, including the likes of non-farms, those bank decisions, so on and so forth, have already come out. So if you were a senior trader on a bank desk, now would be probably your most opportune week to go away. That, in combination with the kids on school holiday, so on, does mean that, generally speaking, this is probably one of the quietest months that or quietest weeks that we'll see throughout the month of August. Nonetheless, though, things to keep an eye out for. 9:30, you've got UK industrial manufacturing production. However, probably slight caveat on that. The calendar is indicated here. These are June readings. It's not really June we're concerned about when it comes to UK economic data. It's July and after, so we can capture the impact of what the Brexit has had on the UK economy. US, similarly, likewise quiet. No real major tier 1 numbers. We've got unit labour costs, non-farm productivity. So again, keep things tight and well managed, and remain disciplined in this type of environment, because it is going to be quiet. Okay, enjoy your session, guys. Going to finish up there, and I'll catch you in the room. Thank you.